Thank you for joining us this Friday, the 15th of July. I'm Sophia, a market analyst with Bell Direct, and this is the weekly market update. While US consumer price inflation jumped to 9.1% in June, the highest in over 4 decades, while US real average hourly earnings saw an annual decline of 3.6% in the US. All three US benchmarks are in the red week to date. The worsening expectations of baseline economic growth in the US saw cyclical market segments decline, such as the financials and industrials. In the Treasury market, we've seen the yield curve inversion intensify. We've seen an over 100 basis point twist between the 2-year and the 10-year points on the US yield curve in the last month. And now the inversion between the two has reached its biggest point since the year 2000. The 2-year Treasury yield in particular is more sensitive to monetary policy changes, so the move came after the CPI announcement. Investors are now awaiting the next rate hike and considering all of this, rebalancing portfolios back to planned asset allocations. Now, while US markets had a mild reaction to the CPI announcement, inflation at 9.1% is still a very high figure. So a few months ago, it was widely predicted that by this time of the year, inflation would have peaked. However, this hasn't happened and inflation is expected to continue to rise this year. It poses questions around the likelihood of a US recession and what that would mean for markets. So we know the markets hate uncertainty and recession fears have already taken effect. Wall Street has dropped 21% this year, while commodity prices have also sharply declined in the last month. Now, despite this, US markets remain stable when you look at it from the perspective that profit margins are maintaining near record highs, and we haven't seen any significant downgrades in the latest earnings forecasts. It likely means that the US stock markets haven't priced in a recession yet, and stocks could fall even further in a recessionary scenario as corporate earnings begin to suffer. Locally, Australia's unemployment rate for June dropped to 3.5% from 3.9% in the prior 3 months. This was well below market forecasts of 3.8% as the economy continues to recover from the pandemic. So what's caused movements in local markets this week? Commodity prices and company news. Monday to Thursday, the Australian market is down 0.4%, with materials falling 3%, while healthcare gained 3%. On the ASX 200, New Hope Corporation, NHC, is the best performing stock this week, with coal prices jumping higher as Asian and European nations have been looking for energy sources outside of Russia. Other coal stocks also took the lead, including Coronado Global Resources, CRN, and Whitehaven Coal, WHC. On the other hand, EML Payments declined 18% this week, however rebounded on Thursday after the company's former MD and CEO spoke out about his surprising departure. And looking at the All Ords now, buy now pay later company Sezzle, SZL, was the worst performer, falling 57% this week after news that fellow BNPL company Zip walked away from their deal to acquire Sezzle. Meanwhile, 88 Energy, that's 88E, surged 50% after a positive quarterly update. The most traded stocks by Bell Direct clients this week were Whitehaven Coal, WHC, Mineral Resources, MIN, Westpac, WBC, ANZ, CSL, Rio and BHP. Clients also bought into Commonwealth Bank, CBA, while took profits from Fortescue Metals, FMG and the ASX. And the most traded ETFs this week were the BetaShares Active Australian Hybrids Fund, HBRD, and the BetaShares Australian Strong Bear Hedge Fund, BBOZ. And lastly, economic data to look out for next week includes the RBA's meeting minutes for its July meeting out on Tuesday, and the S&P Global Manufacturing and Services Flash PMI, and that's on Friday. And that's all we have time for this week. I'm Sophia with Bell Direct. Have a great Friday and enjoy your weekend.